Basically, there are three reasons maybe to buy term insurance. Replacement of income, protection of family, possibly business, but maybe the very important, because you're still young, could be that you might reach age 65 and you want to create a tax-free income, and then the same protection what you bought today, for tomorrow, and after tomorrow will be very valuable in your portfolio. So what we do in our office for the last 34 years, we are long in business, we analyze your needs. Basically there are four categories. You can have 10-year term, you can have 20-year term, you can have 30-year term, and you can have term to 100. What's the difference? Well, there's no difference in the coverage. It's because if you buy $1 million today, if it's 10-year term, 20, 30, or term to 100, the face amount, that means to say when you pass away, they'll pay $1 million. The difference is in the time and the deposits. In reality, what there's a regular term insurance. It's very simple. You buy $1 million, they always pay $1 million. If the premiums go up by every 10 years or 20 years or 30 years, or you pay the level, it's always stay $1 million. So that's one. Then you have the zero cost, where you have the same $1 million and you deposit, let's say, $90 a month or $1,900 a year, and when you pass away, they always refund you 100% of your deposits during the term, 10 or 20, and even if you convert it into permanent, the premiums you have paid on term insurance will be added to your new policy, so you will never lose any penny you deposited. The third one is, it's a regular term insurance, but it has very important features. So if you buy $1 million 10-year term, and within the first 5 years, you can convert it into 20-year term without no medical. Very important, because 99% of companies, if you buy 10, you want to go to 20, you need a medical. Now these are the three features are on the market. But there's a fourth one. It's called the Swiss effect. If you invest $2 a year, I repeat, $2 a year, and you earn 100% interest rates per year, and you pay 50% income tax, would you know what your account would be worth 20 years later? It's $19,000. But if you invest the same $2 a year for 100% interest rates and zero income tax, do you know what would be your value? It's going to be $4.1 million. Is there a difference? If simplistically, what I suggest to everybody, you should look for 3 R's. So the right amount. Second, the right product. And the number 3, you need the right coach. So it's not enough to go on the internet and buy insurance. Make sure that with the internet comes the right coach. Part of the coaching is how we make sure that your legal papers are set up properly, so your proceeds and other assets which you maybe don't have with us, or you do, go to the right hand at the right time, maybe the fastest way possible, because that's when people need money, cash, liquid, when something goes wrong. If you don't have the proper coach, you are very lucky, because you call us and we'll be more than happy, with an obligation in the beginning, to just sit down and discuss where do you want to be 5, 10, 15, 20, 30 years from now. Remember, it is very important. Many people think, some institutions say, after age 50 you don't need protection or insurance or whatever you want to call it. Well, we can coach you and show you how this product, even when you have no kids, no liabilities, can bring you thousands and thousands and thousands of dollars from the investment return money while you're still alive.